If you're a rational-minded person and you hear of all these people making money in the stock market, you might be confused.
A lot of that is coming through Robinhood. That's a bunch of people writing, they're gambling on the price of Apple.
Well, stock's price and a company's success don't always go directly hand in hand. What's up, everybody? I am Jaspreet Singh from the MinorityMindset.com, where money minds rethink rich. Index investing is one of the most accessible ways for you to go out and invest your money, because now you're going to be passively and consistently investing your money into the market, and you're going to let the market do its thing and help you become more wealthy. And in this video, I'm going to be going over 7 things that you need to know when it comes to index investing. So let's jump right into it. The stock market is one of the most accessible wealth building tools that we have, but the issue is most of us are never taught about how to use the stock market the right way. For a lot of people, stock market investing is finding a hot stock, throwing your money into it, and then watching your money disappear. Oh, not again. If you really want to understand the stock market, there's 5 things you need to know. First, you need to understand what is the stock market. In this section, I'm going to be going over what's the Dow Jones, NASDAQ, S&P 500, why does the stock market exist, and how do stocks work. After that, we're going to be talking about how you can make money. So this is the difference between making money through dividends and appreciation, what causes a stock to go up. Then we're going to talk about different investing strategies. You might have heard people talk about fundamental analysis, technical analysis. I'll be talking about active investing and passive investing in this section. Then I'm going to be talking about some of the different investment options you have. You might have heard people talk about things like growth stocks, blue chip stocks, REITs. We're also going to be talking about mutual funds, index funds, and ETFs. And then we're going to wrap it up by talking about how do you actually research the stocks and take action. So this is looking at things like 10Ks, 10Qs, researching stock charts. This is where you actually are making the money, because now you're taking action. I'm going to be going over these 5 things in this video, but before I do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. Let's start with this. What in the world is the stock market? The stock market is a place where you and I, regular people, can go and invest in companies. When you invest in a company, you become one of the owners of a company. So if you go out and you buy one of the shares of the McDonald's stock, you become one of the owners of McDonald's. Now, if you just buy one stock, you're not a major shareholder. I mean, you only own 1/750 millionth of the company, but you're still one of the owners of McDonald's. And as an owner, you actually get the right to vote on some of McDonald's business decisions. A company that trades on the stock market is known as a public company, because this company is publicly traded, meaning anybody can go and buy shares of this company on the stock market. You can compare that to a private company, kind of like ours, Minority Mindset, because you can't buy shares of Minority Mindset on the stock market. If you wanted to buy an ownership stake in Minority Mindset, you would have to call me up and I would say, sorry, we're not selling. The reason the stock market exists is it's a way for companies to finance the future growth. So if you are a big company and you need more cash to grow, then what you can do is you could sell 20% of your company now, instead of to private investors, to the public market on the stock market, by now giving this 20% of ownership to the public on the stock market. Now you are a publicly traded company and everybody knows how much your company is worth, and people have the opportunity to buy shares in your company. When you hear people say things like the stock market is up or the stock market is down, what they usually mean is an index like the Dow Jones or the S&P 500 or the NASDAQ is up or down. So these are called indexes because they're essentially baskets or groups of stocks. The Dow Jones is a group of 30 very big companies. The S&P 500 is a group of 500 of the largest companies on the stock market, and the NASDAQ is a group of tech companies. So they're called indexes because they're groups of stocks, and they essentially just give you a sample of what's going on in the broader stock market. When you invest in the stock market, you can invest into individual companies like McDonald's, I mentioned that just a minute ago, or you can invest in an index and get exposure to the broader stock market, but I'll be talking about that in just a little bit. Second, how do you make money in the stock market? Well, in general, the goal in the stock market is to invest in a company that becomes more profitable and makes more money. That way you make money, but the way you make money is one of 2 ways. When you invest in the stock market, you can make money through appreciation or dividends. Appreciation is when you invest in a company and the value of a company goes up. So if you invest in a stock and you buy the stock at $100 a share, and 2 years later the stock goes to $200 a share and you sell it, the $100 of profit that you just made is called appreciation. Other times you can also make money through dividends. Dividends are literally just cash payments that a company gives you because you invested in a company. So if you go out and invest in a company that's trading for $100 a share, sometimes this company is going to send you a $5 check every single year just because you own shares of this company. You can think of it this way. When a company is mature and they have a lot of cash and a lot of profits, there's three things that they can do with their extra cash. They can save this cash for an emergency, they can invest this money back into their business, that way they can grow bigger, or they can reward you, the shareholders, the investors, by giving you some cash. That way now you're happy for investing in this company, and this will attract more investors to want to invest in this company. Most dividends are paid quarterly, meaning every 3 months. So if you invest in a company that pays a dividend, you're gonna get a check every 3 months, or if you want, you can have this cash reinvested into your stock. That way now instead of getting a physical check, you are getting more stock in the company. Now, dividends sound cool. I'm a big fan of dividends, but there are a couple drawbacks with dividends that I want you to understand. First, when a company pays a dividend, you have to understand that means the company is not necessarily going to grow as fast, because if a company is paying out $1 billion in dividends, then that's $1 billion the company is not using to actually grow the company to make more profits and make more revenue. So if you have a company that's paying out a lot of dividends, you're typically not going to see as much appreciation as you would if a company was using this money that's spent on dividends to actually grow the company. So if a company is paying out dividends, they're usually more stable companies and they're bigger companies because they have a lot of cash that they don't really want to invest back into the company, so they're rewarding their owners with the dividends. Second, with dividends, you have to pay taxes on your profits. So this is kind of like your pro and con. You have to pay taxes on all of your income, but with dividends, if you are reinvesting your dividends back into the company, you're not getting this cash in your hand, but you still have to pay taxes on the profits that you got. Not every company pays a dividend. So if this is something you're interested in, you have to look into the actual company and see if they're paying a dividend or not. And like I was saying before, the companies that pay dividends are typically your larger, kind of more mature and established companies, because your smaller companies, your growth companies, the tech companies, the ones that are really trying to grow fast, they're investing every dollar they can back into the company because their goal is to grow as big as possible, as fast as possible. So companies like that, their goal is to grow their stock price as fast as they can. The advantage with that, if you're investing in a company that's investing heavily in their growth, is you don't have to pay taxes on dividends because you're not getting any dividends. A company is investing their money back into the company, so hopefully you have a big stock price and you don't have to pay any taxes on your appreciation until you actually sell your stock. So that's one of the advantages of appreciation. But one of the downfalls is it also comes with more risk, because there's a chance that the company will fail, and if the company fails, you don't have anything to show for it because you didn't get any cash through dividends. So they both have the pros and cons, and as an investor, you need to know why you're investing. Are you investing for this or this? The question now you might be wondering is, what causes a stock price to go up? Well, on a very broad level and a very simple level, stock prices go up based on supply and demand. If you have a lot of demand to buy a stock and there's not a huge supply of stock, then the price of the stock is going to go up because you're going to have buyers that are fighting each other to buy the stock, and this is going to push the stock price up. And if you have a lot of supply but no demand because nobody wants to buy the stock, then you're going to see the price of the stock fall. In the short term, the supply and demand is really fueled by emotion. Like, people might think, oh my God, Tesla is the future, and everybody gets behind Tesla, and then you see this huge demand to buy Tesla, so the price of Tesla stock goes up. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making, how are their profits looking, are their revenues growing, are their profits growing, how is the management, and are they innovating for the future? So these are the things that really affect a company's stock price over the long term. But in the short term, a company's stock price can be really volatile based off of people's emotions, because the stock market is emotional. If you want to invest in stocks, it is very simple. All you have to do is open up a free account with a stock brokerage, and then you can buy or sell whatever stocks you want. Back in the day, it wasn't so easy. Back in the day, if you wanted to invest in the stock market, you'd have to call up a stockbroker, and then the stockbroker would then have to make a deal with Wall Street and then buy or sell whatever stock you want. It was a very long and difficult process, but now it is very simple. If you do want to learn more about how you can find a good stock brokerage to use based off of your financial goals, our team has articles on this on our website, theminoritymindset.com, and I'll also link an article for you up here and in the description below. Third, let's talk about investing strategies, because there's more than one way to invest in the stock market. And this is one of the biggest mistakes that people make when they invest in the stock market, because for a lot of people, their strategy is invest in a company that I think is going to be big, and then when it goes down, sell it for a loss. There's a lot of ways to invest in the stock market, and you need to have a strategy on how you're going to make money. If you want to be a stock market investor, then when you buy an investment, your goal should be to own your investment for at least a year. because if you don't own your investment for at least a year, then you're also going to be subject to higher taxes, because the way that the tax code works, if you own your investment for longer than a year, then that's categorized as long-term capital gains and you get lower tax rates. But if you buy a stock and sell it for a profit in less than a year, then you're going to be subject to higher taxes called your ordinary income taxes, because the United States government and the IRS doesn't look at that as an investment, because now you're just trading, you're flipping stocks. This isn't to say that you cannot make money trading stocks. This is for you to understand what your goal is as an investor, because if you don't know what your goal is as an investor, you're not going to be able to come up with a strategy. On the very highest level, there are two different kinds of investment strategies. There is an active way investing in the stock market and a passive way. An active investment strategy means that you're now actively researching companies and stocks and you're buying based off of that. And passive means you're not really doing much research. You just have some money automatically being invested for you every week or every month. Now, within this type of active investing, there's a whole bunch of different strategies that you can use, but they ultimately come down to doing two different types of research. You can either do fundamental research, so I'm gonna call it fund, or technical research. Or you can also do both depending on what strategy you have, but those are the two types of research you can do, fundamental or technical. As a passive investor, you're mainly going to be looking at the fundamental type of research. Fundamental research means you're looking at the company itself. You're looking at how much money a company is making, what their profits are, who the management is, and how they're innovating. Technical research means you're looking at stock charts. You're looking at momentum. You're saying, oh, this company looks like it's about to go up because of all these indicators, and so you buy based off of that. Warren Buffett is a fundamental investor. He likes to look at companies, he likes to read financial statements, and he wants to find a company that's undervalued, and he wants to own it for a long time. That way he can make a profit over the long term. And he is an active investor because he does the research to actually find the companies to invest in, and he is the one that's picking these stocks and doing this research, and he makes these decisions when he thinks it's a good time to invest. You can compare that to a passive fundamental investment, where now you can pick a few stocks or a few funds that you want to own, and then every single month you have $100 or $1,000 or $10,000, whatever you can afford. You have this money going into your investments, being divided up into your 3 or 5 funds, whatever you have, and this is just passively happening without you actively trying to find new funds. It's just every month or every week, more money is just being invested into your account. Technical trading is now when you're looking at stock charts and you're looking at momentum. You're looking at different indicators that tell you that you think the stock price is going to go up. Maybe you're looking at how many people are buying the stocks of the volume. Maybe you're looking at moving averages to kind of see the trend of which way the stock price is moving. So you're looking at different indicators to tell you that you think the stock market is going up, at least in the short term. If you don't like the idea of putting time into the stock market, or if you don't care about studying companies, or if you don't care about stock charts, then passive investing is probably best for you, because this one requires the least amount of work. You find a few stocks or funds that you want to invest in, and then every week or every month, you are just going to continue to put money into that. If you like the idea of looking at companies, but you don't like the idea of looking at stock charts or looking at these moving averages, you just want to invest in a company like Warren Buffett does because you want to find an undervalued company and invest in it for the long term, then being an active fundamental investor is probably best for you. If you don't like the idea of waiting years to potentially see a profit, then technical investing is probably better for you. Now, while technical investing can make you the most money in the short term, it also comes with the most risk, because your goal is to make money in a shorter amount of time. A lot of technical investors are buying and selling stocks within a year. Fundamental investors are usually looking to make money over the long term. So now we're talking multiple years, and so there's less risk, but also less opportunity to make a whole bunch of money very quickly. For the vast majority of people who don't care about studying companies or reading financial statements or spending time learning the stock market, passive investing is the right way to go. Now, I already made a video where I went over passive investing in good detail, so if you want to watch that video, I will link it for you in the description below. Fourth, let's talk about the different types of investments on the stock market, because one way you can invest in the stock market is by investing in stocks. But that's not the only way that you can invest in the stock market. You can invest in the stock market and make money in the stock market by investing in individual stocks. You can invest in mutual funds, you can invest in index funds, and you can invest in ETFs. If you are subscribed to our YouTube channel, you've probably heard me talk about these things before, and if you're not subscribed to our YouTube channel, you should probably do that. Stocks are when you're investing in individual companies. This is what I've been talking about most of this video. So if you invest in the McDonald's company, or in Lululemon, or in Tesla, or in Amazon, or in Apple, now you're investing in individual companies. And within the stock segment, there are different types of stocks out there. Like, you can invest in blue chip companies. These are your more stable, more established, your larger companies. You can invest in growth companies. Growth companies are your startups, your smaller companies. These are companies that are investing heavily into their growth. So growth companies are not companies that are paying out dividends. These are companies that are spending every dollar they have back into their company to grow as big as possible, as fast as possible. So more risk, but the opportunity to see more appreciation. You have things like REIT stocks. REIT stocks stand for real estate investment trusts. These are companies that pay out high dividends because these companies make money through rent, and the law says that REIT stocks are required to pay you 90% of their taxable income through dividends. So REITs give people exposure to real estate, and you can make income through dividends without having to go out and physically buy real estate. So these are a few ways that you can invest in stocks. And again, you want to invest in stocks based off of your investment strategy, your investment goals. But this isn't the only way to invest in the stock market, because the downfall with investing in stocks is if you invest your money in a stock, let's say Amazon, and Amazon starts to fail, they start losing money and they go out of business, then all of your money goes down the drain. Now you might be thinking, oh, Amazon's never gonna fail. But you know, companies do fail. And if you invest in a company that fails, then all of your money is gone. That's where these options come in handy. Mutual funds are indexes, so a group of stocks that are managed by a very experienced and usually a very expensive money manager. So when you invest in a mutual fund, you are paying this money manager to find you a portfolio and investment of stocks, and this person is going to manage your stock portfolio, and their goal is to help you beat the market, and in exchange, you're going to pay them a fee. Index funds work very similar to mutual funds, except with index funds, you're not paying a money manager to manage your account. This is passively managed by a computer. So essentially with an index fund, you can invest into an index, like you can invest into an index that gives you exposure to the top 500 companies on the stock market. And now if these top 500 companies go up, your index fund goes up. If these top 500 companies go down, your index goes down. The advantage with index funds is you tend to have low fees, you tend to have less risk, and you can typically match the returns of the stock market. The downfall is you typically have less potential upside because you might have some great companies in your fund, but they're going to be balanced out by the losers. But this can be a good way for you to invest and get low fees and get exposure to the general stock market. An ETF is an exchange traded fund, and this is kind of like a basket statement, because all this means is this is a fund that you can buy and sell on a digital stock brokerage. So the reason the word ETF even exists is because a lot of mutual funds cannot be bought and sold on the stock market. If you want to buy a lot of mutual funds, you have to call up a broker and purchase shares of a mutual fund manually. With an ETF, it's all electronic, so you can buy and sell shares of this ETF kind of like you would any other stock. Now look, I am just a random guy on YouTube, okay? So you should always do your own due diligence and never blindly listen to a random guy on YouTube, because investing has risks and you are never guaranteed to make money when you invest. But a couple examples of index funds that give you exposure to the general stock market are VOO and SPY. If you invest in one of these two funds, you will get exposure to the top 500 companies in the stock market, and now you don't have to go out and try to find the best stock to invest in. Now you're investing in the general stock market. I want to kind of give you an idea of what long-term returns in the stock market look like when you play the stock market for the long game. So over the long term, the stock market typically goes up by somewhere between 7 and 10% a year. Now, this doesn't mean the stock market always goes up, and this doesn't mean that it always goes up by 7 to 10% a year. This means on average, it goes up by 7 to 10% a year. Some years it'll be more, some years it'll be less. Sticking with the lower end of the equation, let's say you invest $10 a day or $300 a month, and you can get a 7% return on your money. And let's say you do this for 45 years. So you start doing this when you are 21 years old, and you continue to do this until you retire at 66. If you do this and every single month you invest $300, you will retire with $1.1 million from your $10 a day investment. The reason I want to show you this, because let's say you start a little bit later. Let's say you start investing not at 21, but now at 31, and you continue to do this until you're 66. So now this is 35 years, but you're still doing the same investment. You're still doing $10 a day or $300 a month. Now, if you do the same investment, you're not going to retire with $1.1 million. You're going to retire with $535,000. Still a lot of money, but you're leaving a lot of money on the table because your money doesn't have as much time to compound. Time is very important when it comes to investing your money over the long term, because every single year your money has more time to grow and compound, and the longer you let your money grow, the more wealth it's going to build you. If you want to grow your money even more, then there's two things you can do. You can either invest more money or invest your money more aggressively, meaning get a better rate of return. So let's assume now that you're investing $20 a day and you continue to get the 7% return a year. If you do this for 45 years, so you start when you're 21 and you continue to do do this until you're 66, then you are going to retire with over $2.2 million from your $600 a month investment. If you cut 10 years out of the equation because you didn't know about investing until you're 31, so you do this for 35 years, now you will only retire with $1 million. Now, I know, only $1 million. $1 million is still a lot of money, but you're leaving a lot of money on the table by not starting sooner. This is where a lot of people say things like, oh, I didn't start investing when I was younger. Did I miss my shot at becoming wealthy? Is it too late for me to start investing? No, it's not. Remember what I said before. If you want to get better returns, you either have to invest more money or invest more aggressively. Maybe you have to invest more money, or maybe you have to be a little bit more active with your investments. That way you can get a better return. So now let's go through this example again, where you're investing $20 a day and now you're a little bit more aggressive. So you're trying to get a 10% return. If you do this for 45 years, just to show you the example, now you're going to end up with $5.5 million. If you start a little bit later at 31 years old and you do this for 35 years, now you're going to end up with $2.2 million. So you're still a millionaire. And if you start this at 41 years old, now you only do this for 25 years, you're still going to end up with $750,000 in retirement. So time and consistency are very important for you to build this wealth over the long term. And if you're trying to make up for this lost time, then you need to either invest more aggressively or invest more money. And if you don't have extra money to invest, then you might have to look into doing something like a side hustle or starting your own business. That way you have extra cash to invest. That way you can build your wealth. And this is also more of a passive investing structure. Right now, you're not trying to get amazing returns. You're just trying to match the market by passively investing your money into a fund that gives you the same returns as the stock market. Active returns can get you better returns, but again, it comes with more risk. Like if you had invested $10,000 in Amazon back in 2010, that $10,000 investment would have grown to $170,000 in 2020, but that again comes with more risk because there's a lot of companies that didn't get the same returns as Amazon. Now, when it comes to research and taking action on your investments, you have to understand that the investors that make the most money are not the investors that invest on emotion. It's the investors that invest on financials. A lot of people are investing in the stock market when they feel excited because they think, oh my God, so many people are making money in this stock, so let me buy in. And then when the stock starts to come down, they panic and they sell. If I had to diagram it out for you, it looks something like this. So you see a stock go up like this, then somebody at this point gets excited, they get greedy and they say, oh, everybody's making so much money because the stock has shot up so much. So now they come in and buy at the peak. And then people realize that, oh, this stock might be a little overvalued. So they start taking off their profits right here. And what do you see happen? The stock price starts to come down. And now when the stock starts to come down, people start to panic sell. And now this is where you sell because you panic, you get worried, you see your stock in the red, and so people sell. I do not want you to be an emotional investor. I want you to be a financial investor, which means you need to know how to do the research. That way you can find the information you need to actually invest in a company for the long term to make money. When a company is publicly traded, so it's on the stock market, it is required by the SEC to release certain information about the company. That way people like you, investors, can make smart decisions. One of the things that a company is required to do is every 3 months or every quarter, it is required to have an earnings call where it releases something called a 10Q. A 10Q is its quarterly, so every 3 months, a quarterly financial statement. This statement will tell you how much money a company made, how much revenue it made, how much profit it made, how much money it lost. This is how much money it made over the last quarter that it's reporting for. But what you need to remember about the 10Q is these are unaudited statements. So these are statements just released by the company. A 10K is an annual statement released by a company. So every single year, a company is going to have to compile all of their financial data for the last year, how much money they made, how much money they lost, where their money is going, and all of that information, and they're going to compile it into the 10K. The interesting thing about the 10K is this is supposed to be a little bit more accurate because these are financially audited statements. You want to be reading the information that's on these documents. Now, if you don't want to actually read these actual financial statements, what you can do is go to a stock website like Seeking Alpha or finance.yahoo.com. I'll link these for you in the description. You can go to these websites and they're going to break down the information that's in these financial statements. So you can go there and see how much revenue a company is making, how their revenues have been growing, how their profits have been doing, and everything else, and they will list it out for you. That way you can look at the financials of a company. When it comes to doing technical analysis, that's when you're going to want to be looking at stock charts. So you can go to a website like stockcharts.com, and then you can look at different indicators for a stock. There are tons and tons and tons of different indicators out there. And so what you want to do is create a strategy that you follow, because one indicator might tell you to sell and another indicator might tell you to buy. So you need to make sure that you have your own strategy and look at the indicators for that and follow your investment goals based off of your strategy, because if you don't, then you're going to go down this rabbit hole of never knowing what to buy and when to sell, and it is going to be very overwhelming. Before we get into the next clip, I do want to let you know that if you are interested in learning more about how to invest your money into the stock market, our team has a free guide on investing your money in the stock market. This free guide will go over different stock market strategies, how to invest your money in the stock market, and how to build long-term wealth in the stock market by investing your money. So if you want to learn more about this guide and you want to start learning about how you can analyze companies and how you can research companies and how you can find good companies to invest in for the long term, that way you can build wealth in the stock market, you can read this guide for free when you sign up for our daily newsletter. If you want to read this free guide and start learning about how to invest your money in the stock market, I'll put the link to how you can download this guide in the description below. The stock market is one of the most accessible wealth building tools that you can access, but lots of people never actually end up making money or building wealth in the stock market. There are essentially two ways that you can invest in the stock market. You have the cool way, oh yeah, and then you have the boring but profitable way, oh yeah. When most people invest in the stock market, they're trying to find the next Amazon or Tesla. They're trying to be cool. It's the cool way to invest because you want to find the next hot stock and buy it before it gets big. You can make a lot of money doing that, but it takes a lot of time and it takes a lot of research, and most people don't actually put in the work to do it. They're just gambling. And there's a lot of people, especially when you first enter the stock market, that get really allured by this idea of being able to flip a stock very quickly for a huge profit. Like you see this penny stock trading at 4 cents a share and you think, whoa, what if I buy $1,000 worth of this stock and it goes up to 8 cents a share? That's not that big of a jump. If that happens, I'm gonna make $1,000. And if the stock goes up to $1, I'm gonna have $25,000 doing nothing. And the next thing you know, your money's gone because that stock went out of business. Trust me, I know, I've been there. Even if you're too smart for penny stocks and you're investing in well-established companies, chances are you felt the pain of investing in a company and then you see your stock go down. I mean, that's why so many people are searching, why do stocks go down when I buy them on Google? So now you have a lot of people that are investing in companies and losing money, and then you also have this big group of people that are scared to invest in stocks because they see all these people lose their money. But there is another way that you can invest in stocks that doesn't have as much risk, where you don't have to try to find the perfect company, where you can build sustainable wealth. The downfall with this is kind of boring. It's not as cool as trying to find the next Amazon. So what is this secret system? Index funds. Index funds, not to be confused with index fingers or index cards, are a simpler but boring way for you to invest in stocks and build profit over the long term while compounding your wealth. That's why in this video, I'm going to be going over index funds, and more specifically, Vanguard index funds, and you'll see what I mean in just a minute. An index is a group of stocks, is a segment, and a fund is something that you can invest in. So as a simple example, let's say you really like tech companies, but you don't know how to find the best tech stock. So let's create a tech index fund. So remember, an index is a group of stocks, and in this, we're gonna create one right now. Let's put in Amazon, AMZ, and these are the ticker symbols, Facebook, Google, what's another tech stock? Apple, AAPL. So now we have just created an index, which is a group of stocks. Now, if you want to invest in this group of stocks and you don't want to individually invest in all these companies, you can invest into this fund. So now this has just become a fund. This fund invests in these individual stocks and you can buy shares of this fund. Now, you're not going to be the person that's actually creating the fund because there's a lot of complexities into that and they get a lot bigger than this. I'm just showing you kind of as an example of what an index is, but you as an investor can invest into a fund which invests in a bunch of stocks. That way you don't have to try to find the best company to invest in. The reason passively managed index funds have become so popular is because back in the day, the only way that you could invest in funds was by investing in what's called actively managed funds. Here's the thing, someone or something has to manage this index of stocks, because if Facebook goes out of business because people don't want Facebook anymore and people stop buying Apple iPhones, then what's going to happen to this fund? You're going to have only some stocks that are doing well and all these stocks that are going bankrupt, and if that's the case, your investment is going to tank. So someone or something is going to have to actually manage this fund to make sure that the stocks in here are doing well, and you're not going to be the one doing that, because the whole point of investing in this fund is so that you don't have to do all the work. In actively managed funds, what would happen is you would have this person right here manage this index. So let's draw a nice mustache on this person. And this person probably went to Yale for undergrad, and they went to Wharton for business school for their MBA. And to most people, that means they're probably very smart. Now, to me, I'm sure they're very smart, but what that means to me is they're probably going to charge you a whole lot of money. And that's exactly what these money managers did. So they would create this fund, and then they would charge you a whole lot of money. So this is you, the investor, and a lot of your money would go right into this person with a mustache's pocket. So if you wanted to invest in stocks, but you didn't want to put in the time and effort to research companies and to manage your stocks, then what you would do is you would hand over your money to this money manager with a mustache who went to Yale, who went to Wharton, who is now going to charge you a whole lot of money to take your money and put it into this index or fund that they are managing. And if your index, your investment goes down, they're still going to charge you a lot of money. This model is why index funds, as we know them today, were created. Now, I have nothing against mustaches, but I really like the idea of people being able to invest their money without paying all their money in fees. The way it worked is, instead of having this guy with a mustache manage your money, how about, and let me erase the mustache and the person, how about we just have a computer manage your investments, because computers are a whole lot cheaper to manage, and we can just tell the computer, hey, why don't we just create this investment where this fund invests in the top 10 tech companies. And now if Facebook goes bankrupt, this computer can automatically kick Facebook out and put in a new company. So this was automation coming into the money management and investment game, because now instead of paying an expensive money manager, people can create an algorithm of what type of companies they want to invest in. And so if you want to invest in the top 10 tech companies and one company goes below that threshold, this computer will automatically kick this company out of the fund and bring in a new company. Like if Facebook goes out, maybe Snapchat will come in. This computer will automatically calculate that and make these transactions. That way your fund has the stocks that you have in the algorithm. Two things happen when you do this. First, you as the investor, you get to save a whole lot of money, because managing a computer is a whole lot cheaper than paying a money manager who went to Yale and who went to Wharton to manage your money. And second, you get to take the emotion out of investing. The reason so many people, including high-paid money managers, lose money in the market is because people are emotional beings. When the 2020 pandemic hit and the stock market crashed, do you want to know what a lot of expensive money managers did? They sold. They were selling stocks out of their fund out of fear. If your fund manager makes bad trades and you lose money in your investment, but you also have to keep paying your money manager. Look, there's a time and a place for actively managed funds, but if you really want to get the good money managers, you need a lot of money to invest with them. So now we're talking millions of dollars. If you don't have millions of dollars to invest, chances are you're not going to get access to the greatest money managers. Passively managed funds let you invest your money into stocks while paying low fees, and a lot of times these passively managed funds will get you better returns than actively managed funds, and you get to pay way less in fees. But in order for index funds to build you wealth and really make you money, you have to invest in them the right way, because this isn't one of those things where you can just invest in an index fund on Monday and expect to be rich by Wednesday. Index fund investing is a long-term wealth building tool, and the way you make the most money and build the most wealth by investing in index funds is by investing money consistently into the index funds and investments that you have. So this is investing money every week or every month into your funds. Now, investing has risks, okay? You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. But let's take a look at this. So VOO is an index fund created by Vanguard, and VOO invests in the top 500 companies in the stock market. Okay, so VOO is that index fund and invests in these top 500 companies. So now what you can do is you can invest into this fund. Again, I'm not telling you what to buy, just an example. And this fund gives you exposure to the top 500 companies. Between November of 2010 and November of 2020, VOO, this index fund, returned an average of 13% a year over the last 10 years. This doesn't mean that the fund went up by 13% every single year consistently. It means some years it went up more than 13%, some years it went down by 13%, but on average over those 10 years, this fund went up by 13% a year. Let's put this in perspective. Let's say you had $10,000 and you put this money into the bank. And I'm going to be very generous, and I'm going to say that your bank paid you 0.5% a year in interest. If you did that over 10 years, your $10,000 would grow, and it would grow to a whopping $10,000 $500 after 1 decade. If you put your $10,000 here into this index fund that gave you general exposure to the stock market, then your money would have grown from $10,000 all the way up to $33,000. And this is on the side without you doing any work. You just put your money in and then you go do something else. Now, I get it. Hindsight is 20/20. Of course, it's easy for me to look back and say, hey, you should have done this. But this is the reality of how investing works, okay? If you don't take risks, your money is not going to grow. Again, past performance does not indicate future performance, but let's just assume for a second that you can maintain that 13% return that we just saw in the previous example. But let's say that you don't have $10,000 to put into an investment. So instead of putting $10,000 cash into an investment, you do something a lot smaller. You do $250 a month. Now, whether the fund goes up or down, you're going to put $250 a month every single month into your fund, and you're going to do this no matter what, and you're going to do this for 10 years. So for the next 10 years, you're going to keep putting $250 a month into your investment, and over those 10 years, you will have put $30,000 into your investment. But assuming you get the same average return, your $30,000 will have grown to $63,000 on the side. But let's keep going. Let's say you do this for another 10 years. Now you will have put aside $60,000. So this is 10 years, another 10 years, over 20 years into your investment money. But because you're investing this money, you will have grown this money to over $270,000. You got more than $250,000 in your investment account because you're investing this money passively. Again, this is assuming you got a 13% return, but I got this number from the last 10 years of how the stock market has grown and how these index funds that match the general stock market have grown. I'm not saying this is what's guaranteed, but I'm showing you what's possible if you invest your money. And the great thing about this is this investment is passive. You're not trying to find the best stocks. You're not trying to research other companies. You're just putting your money into an investment that's investing in stocks for you. The reason so many people don't do this is because investing in passively managed index funds is not as cool and it's not as hot as trying to find the next Tesla or Amazon. The reality is building long-term sustainable wealth and growing it in the stock market is not easy. Yeah, it looks easy when you're in a bull market because everybody's making money. Then it's easy. You can just throw your money anywhere and you're going to make money. But when things go bad and times get rough, which will happen, you have to anticipate this. This is where you have to have a strategy, and if you are investing in index funds, it's all about just consistently investing every week or every month and letting your investments grow and compound over time. Now, I'm going to be talking about some of the different index funds that there are out there for you to invest in, but before I do that, I want you to be aware of tools that you can use that can help you passively invest your money, like our sponsor M1 Finance. The way it works is simple. You're going to create a free account, and then you go in and you're going to create a pie, which is your investment portfolio, where you can enter in what stocks and funds you want to invest in. So here's an example of what you can do. Let's say you slice up your pie into 5 different slices, and now you can divide it up however you want. You can have fund 1, fund 2, fund 3, fund 4, and let's say you really like Chipotle, so you throw in Chipotle in there too. So now what's going to happen is anytime you invest money into your pie, it's going to automatically be divided up into these 5 different things into the proportions that you created. So I know my numbers are really rough because this pie is really kind of just lopsided, but let's say 35% of this is fund 1, 25% fund 2, and on and on and on. So what happens is if you invest $100 into your pie, $35 is going to go to fund 1, $25 fund 2, $10 to Chipotle, $10 to fund 3, and $20 to fund 4. The cool thing is you can automate this process however you want. So you can create an automation where every single month $250 is withdrawn from your bank account and automatically gets put into this pie the way that you created it. Plus, it costs you nothing to do this because it's free to create an account and they don't charge you money to invest your money automatically through their passive system. So if you want to learn more and start passively investing for free, I got the link to where you can do that with M1 Finance in the description below. Minority Mindset is a paid partner with M1 Finance, so if you use them, we will get compensated, but there's no additional cost to you. It's free to create an account and they don't charge you to do this sort of passive investing. So if you want to learn more and start passively investing, I got the link to where you can do that with M1 Finance in the description below. There are index funds for almost anything you can imagine. You have your general stock market funds like VOO, which I talked about. VOO was created by Vanguard, but you have other ones like SPY, which are not created by Vanguard, Both of them invest in the top 500 companies in the stock market. But you also have sector-specific funds. So these are a little bit more narrow. So these are things like tech funds and growth stock funds and real estate funds and dividend stock funds. Vanguard was the first company to really go out and create these type of index funds, but now lots of companies have them. Now I know this might be a little bit confusing, but finding an index fund is actually a lot easier than you might think. Let's say you want to invest in tech stocks, but you don't want to actually find the best tech company to invest in, so you want to go this fund route. So what you could do is you go to Google and you just search best tech index funds. And what's going to come up is you're going to see all these lists of tech ETFs. All an ETF means is it's a fund that you can buy through a stock brokerage digitally. Remember, back in the day, you couldn't always buy these funds digitally. You had to call up a broker and manually do it. So an ETF just means you can do it digitally. Two things that you want to make sure you pay attention to are what companies your fund invests in and what the fees are. Again, this is very easy to do. You just got to Google it. Going back to VOO, if you go to Google and you search VOO details, it's going to take you to the Vanguard website and you can see the list of all the companies that VOO invests in and the different percentages that it invests in. And you can also see the fees, which is called the expense ratio. At the time we're recording this video, you'll see that the VOO expense ratio is 0.3%, which means for every $100 you invest into this fund, they're going to charge you 3 pennies as a fee for every $100 you invest. So this isn't a lot of money because they're using a computer to help manage your fund. They don't have this fancy guy, an expensive guy with a mustache who you have to pay a ton of money to invest your money and manage your money. The key here is having the right mindset because you want to be investing for the long term because this is a long-term wealth building play. It's also very important for you to stay up to date on what's happening in the top finance and business news. That way you can make smart decisions with your money. And if you're looking for an easy way to do that, that's why we created the free Market Briefs newsletter where our team first breaks down the top finance and business news and then we show you how this news affects your wallet. That way you can be smart with your money. This newsletter is completely free and you can subscribe to our free finance and business newsletter by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are separate from our financial education emails. When I invest my money, there's two things that I always look for. I look at how much risk is involved and I look at how much money I can potentially make. If I was going to invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm going to expect very different returns to justify my investment. Bunty is a risky investment. So I'm going to need bigger potential returns to justify me giving him my cash because as soon as I give him that $10,000, there's a good chance that he's going to invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's going to give you the best return for your risk now? Not so easy anymore. There's 3 different ways that you can take this. Option 1 is you can spend all the time researching these companies and you might decide that Apple is the best company to invest in based off of all your research and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option 2 is now you can open up a stock brokerage and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theminoritymindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock, you got to manage and monitor a whole portfolio of your stocks. Or option 3 is you can pay a small fee and then you can invest in a fund like a mutual fund or an index fund or an ETF and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all 3 of these funds give you exposure to the stock market. They work in very different ways which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here, we're gonna call this person a money manager, and we're gonna draw him a nice mustache. This money manager is who you're trusting. So you're gonna give your money to this money manager, and this money manager is gonna create this fund. So this person is managing this fund, and when this money manager likes a stock, they're gonna buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're gonna replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is gonna make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you were hoping that by paying this money manager a fee, you were gonna be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees, and if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees, and you were able to get an average 7% return on your money, over the next 30 years, you're gonna end up paying something like $166,000 in fees to your money manager just to invest your money. Now look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm gonna go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard, and Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're gonna have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund. And you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title, also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard index fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy 1 share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard index fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard, versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, the index fund gives you the benefit because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks. and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. Do you want to have the automatic reinvestment into an index fund, or do you want to just invest your money into a brokerage that can automatically invest your money for you? Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct, but over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company. Investing in the stock market isn't always easy. The stock market is the most accessible place for somebody to go and invest their money to build wealth, but at the same time, so many people lose their money in the stock market because they either don't know how to invest their money in stocks, they don't know how to research stocks, or they get emotional, they buy a stock, they see it go down a little bit, and then they sell at a loss, and then a few weeks later, the stock pops back up. I knew I shouldn't have sold! If you don't want to spend all of your time researching stocks and picking stocks and keeping up with stocks, then another thing that you can do instead of just trying to invest in individual stocks is invest in something called an ETF or an exchange traded fund. An ETF, you can kind of think of it like a basket of stocks, a group of stocks. Now what you're doing is instead of trying to find the perfect company to invest in, you're investing in a group of stocks which gives you exposure to a whole bunch of stocks. Now, if one of the companies in your ETF goes bankrupt, well, you're okay because your ETF will have hundreds of other companies to make up for that loss. So even if one company goes bankrupt, it's not a big deal. But if you invest in one company and this one company that you invest in goes bankrupt, now your entire investment is gone. The nice thing about ETFs is it makes investing a lot more passive for you because now you don't have to keep up with every individual company. You just find the right ETF, you throw your money in there, and you keep investing your money every week or every month, and now you're just consistently building up this portfolio of this ETF or ETFs that you like, and this ETF is doing all the work to invest your money for you. Plus, ETFs work just like stocks. You can start investing in ETFs with as little as $100, and you can buy or sell your ETF whenever you want. But the whole idea about investing your money in ETFs, just so you know, is you want to be investing for the long term. So we're talking years now where you want to buy something and you want to just keep investing in it and hold it for the long term. That way you allow the market to grow and your companies to grow to make you more money. Now, the thing that makes ETFs really interesting is you have different types of ETFs that give you exposure to different types of stocks. And in this video, I'm going to be going over 7 different types of ETFs with different ETFs within each type that we can understand some of the best ways that you can go out and start investing your money and building wealth. So let's jump into these 7 types of ETFs. The first and probably the most popular group of ETFs are the ones that give you exposure to the S&P 500. So the S&P 500 is just the largest 500 companies in the United States that trade on the stock market. So if you are a company and you are one of the biggest 500 companies on the stock market, well then you are gonna fall into the S&P 500. So this is literally just an index or a group of the biggest 500 companies on the stock market. A couple ETFs that will give you exposure to the S&P 500 are VOO and SPY. Small disclaimer, I do own shares of VOO. Now what you need to understand about this is when you go out and you buy shares of of VOO or SPY on the stock market, this is now an ETF. So when you buy either one of these, you're getting exposure to the 500 largest companies on the stock market. Now you don't have to go out and individually buy each company. These ETFs are out buying these 500 largest companies and they're managing that investment for you. So all you have to do is invest your money into here or here, and now you have exposure to the 500 largest companies on the stock market. Now, before I go any further, I gotta make sure this is clear. Investing money has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. Everything that I'm talking about today are just examples. I'm not telling you what to invest in, and I'm not telling you where you need to invest. I'm giving you examples of how these ETFs work and a couple ETF examples that way you understand where to look. But I want you to do your own research because there are a ton of ETFs out there, so you got to find what's right for you. So the thing that differentiates these two ETFs is one, who manages the ETFs, and then what this ETF actually invests in and how much. So this is a Vanguard ETF and this is a Spider ETF. What that means is Vanguard, the company, is the one that owns and manages this ETF, and Spider is the one that manages this. By the way, just so you know, Spider is spelled SPDR. Now, when we talk about what companies an ETF is invested in, you want to look a little bit deeper than just the companies, because what's going to happen is both of these ETFs are both going to be invested in the biggest 500 companies in the stock market, but one might be invested more in Microsoft than Apple, the other might be more invested in Tesla, and so they both give you exposure to the top 500 companies, and this is where you can do a little bit of research and see how much each ETF is invested into what. One of the easiest ways to do that is just to go to finance.yahoo.com, and then you can just enter in these two ticker symbols, and then you'll see, if you scroll down, you'll see some of the top companies that each of these ETFs are invested in. Or you can go onto the Vanguard website or the Spider website, and they'll show you which companies these ETFs are invested in and how much. That way you can get an idea of which companies you're getting exposure to. Another thing that you can pay attention to when we're comparing different ETFs is the expense ratio. The expense ratio, if you go to finance.yahoo.com, you'll see it there. You'll also see it on both of these websites. This is how much money you're paying to have your money managed by this ETF. So the advantage with an ETF, especially a low-cost ETF, is you're gonna pay way less money to have your money managed here than to have somebody physically managing your money with an actively managed portfolio. So these type of ETFs, these are passively managed, meaning they're managed by a computer. So all these ETFs are doing is they're giving exposure to the top 500 companies in the stock market. If one of the companies in these top 500 companies goes bankrupt or gets smaller, well then this ETF or this computer is just gonna kick out that company and it's gonna put in the next biggest company. That way your money is still being managed by the computer, but it's like an algorithm. It's gonna give you exposure to the 500 biggest companies. The expense ratio on both of these ETFs are very low. It's less than 0.1%, which means if you invest $10,000 into one of these ETFs, they're gonna charge you less than $10 a year to manage your money. But that expense ratio is definitely something you wanna remember as you start comparing more and more ETFs, and as we go deeper in this video, because you're gonna learn about different types of ETFs. And so if you're trying to compare different types of ETFs and see what's better for you, the expense ratio is something you should be paying attention to. The second type of ETF that you might want to consider is a total stock market ETF, kind of like VTI. So a total stock market ETF gives you exposure to the entire stock market. Previously, we talked about the S&P 500 index, which gives you exposure to the 500 biggest companies in the stock market. Something like VTI will give you exposure to the entire stock market with big companies, medium-sized companies, and small-sized companies. So now you're literally just investing your money in the stock market, and if the stock market goes up, your ETF should go up. If the stock market goes down, your ETF in general should go down. So now you're essentially giving yourself exposure to the entire broad market. This is another Vanguard ETF. And the thing you gotta understand about this is if you don't know what sector to invest in or what industry to invest in or kind of a more generalized place to invest, then this might be a good place for you to invest, because now you're just investing your money in the stock market and you're hoping that the stock market will go up. So if you believe in the United States economy, then you should be believing in the United States stock market, which means that in the long term, the United States stock market should go up. And if it does go up, well then this ETF will give you exposure to that. The third type of ETF that you wanna consider are high dividend yielding ETFs. So there's two ways that you can make money in the stock market. You can make money through appreciation, which is when you invest your money in a stock, you bought it for $100 a share, and then the price of the stock goes up to $200 a share, and then you sell. You just made $100 because the price of your stock went up. This is called appreciation. But the second way that you can make money in the stock market is through something called dividends. So at the end of the year, some companies have a lot of cash in their bank account. And when a company has a lot of cash in the bank, there's a few things that they can do with this money. They can save this money for emergencies, they can invest this money back into the company, or they can pay this money back to the investors. They can literally just give it back to you in a cash payment called a dividend. A good company should do all three. So a good mature company is going to save some money for emergencies. They're going to keep investing in their growth. They're going to hire more employees. They're going to open more offices. They're going to open more stores. And then they want to reward their investors, their shareholders, people like you, for investing in and believing in the company. So this is where you have to understand what stage a company is in to be able to pay out a dividend. Because if we're talking about a small startup growth company, well, this company's goal is probably not going to be to reward their investors, because their goal right now is to get as big as possible, as fast as possible. So what they're going to be doing is not saving their money. What they're going to be doing is not paying this money out to their investors. What they're going to be doing is taking all of their cash and more through debt and other investments, and they're going to be reinvesting it back into their company. They're going to want to get more users. They're going to want to get more customers. They're going to want to open more stores. So smaller startup companies are not going to be paying out dividends because they want to get as big as possible, as fast as possible, and every dollar that they have is going to be going right back into their company. But some companies, your more mature companies or larger companies, are going to have this extra cash pile because they're already very large. And at the end of the year, they're going to have a huge profit. And if they want to pay this money out to their investors, one way they can do that is through dividends. It's an actual cash payment that you get without even selling your stock. Now again, there's a couple ways that you can get exposure to these dividends. You can go out and you can individually invest in companies that are paying out high dividends, or you can invest in a dividend paying ETF. So if you invest in a company that's paying out a high dividend, well, now the pro is you'll be able to get a high dividend, and if you invest in a good company, the value of your company will go up. But now the risk is if this company starts to tank, if they are on the verge of bankruptcy, if they start losing money, well then they're going to be forced to cut their dividend, and you can see their stock price crash. The advantage of an ETF now is now you don't have to worry about trying to find the perfect company again, because the ETF is going to give you exposure to a whole bunch of different high dividend paying companies. And now if one company tanks or goes bankrupt, you'll be okay because you're getting exposure to a wide range of companies. The con here is you're not going to get the highest possible dividend because some companies are going to pay a higher dividend than others, and your returns are also going to be averaged out because some companies are not going to do well, but other companies are going to do great. So the goal with an ETF is not to get the best return possible, is to get a slow and steady, consistent return through the market. A couple examples of ETFs that are focused on paying you dividends are VYM and RDIV. Again, these two ETFs are in the business of trying to get you high dividends. This is where, again, you have to know what your goal is as an investor. I know I've talked about this at least 100 times on our YouTube channel, which is why if you haven't subscribed to our channel, make sure you do that. But this is where you got to know your goal, because if your goal is to see your investment portfolio grow as big as possible, then you don't want to be investing in these high dividend ETFs, because these companies are now taking their money and paying it out to their investors instead of taking their money and reinvesting it back into their company. So what you want to do, if your goal is to see your portfolio grow as big as possible, as fast as possible, is not invest into these dividend paying companies. These ETFs are focused on producing you consistent cash flow. It's not going to be the highest cash flow possible, but their goal is to give you consistent cash flow that you can count on. Like what we saw happen in the 2020 pandemic was a lot of companies started to struggle. And because of that, lots of companies started pulling back their dividends. And so people who were invested into these companies that were paying out dividends, hoping for consistent cash flow, were then all of a sudden, almost overnight, left with no more cash flow coming in because lots of companies cut their dividends. And so the whole idea here is to get a safer, which also means lower return, but a safer, more consistent dividend income. The next type of ETF that you may want to consider investing in are emerging market ETFs. The whole idea behind this is, well, now you want to diversify your money outside of just the United States, because the reality is every economy has its own struggles and no economy can continue booming at a consistent rate forever. The United States is the leading economy in the world. The United States is the strongest economy in the world, but some people are naturally worried that another company is going to come around and their economy is going to grow bigger than the United States. Or they're also thinking that smaller countries around the world are growing faster than the United States right now, which makes sense because smaller companies grow faster than bigger companies. When you're this large, big behemoth of a company, it's much harder for you to invest in innovation and grow much bigger because you're already very large. But if you're a small company, well, now you have the ability to grow way bigger faster because you're small, and so you have a lot of opportunity to grow. It's the same with this here. When you're investing in emerging markets, the whole idea is you're taking on a little bit more risk because you're investing in new countries, things like China and India and Brazil. And what you're hoping for here is that these smaller countries are going to see economies that are going to grow faster because they're smaller and they have the opportunity to grow bigger. Plus, you naturally have some people that are a little bit worried about the long-term health of the United States economy, so they want to diversify some of their money outside of just the United States economy. And one way that you can do that is by investing your money into emerging market ETFs, because this gives you exposure to the economies of different countries around the world. Again, a couple examples of this would be VMO and IEMG. These are two different ETFs that give you exposure to emerging markets. Now again, this is where you want to do a little bit of your own research and see which countries each ETF is investing in and see what you'd rather have. Do you want more of an exposure to China, or do you want more exposure to South Korea? And so you just gotta figure out what's important to you, because this ETF is going to give you more exposure to China. This ETF is going to give you exposure to a broader range of countries. But now we're just getting into the details, because in either case, you're going to be getting exposure to emerging markets and emerging countries around the world to give you some diversity outside of just the United States itself. The fifth type of ETFs that you may want to consider investing in are innovation ETFs. We are in the innovation age right now, where technology is growing and innovating way faster than we've ever seen happen before. I mean, for all the 80s and 90s babies out there, you probably remember that when you were a kid, the internet wasn't what it was today. When you had to go on the internet back when you were a kid, you had to make sure that your mom or your dad wasn't on the phone, because you had to go through dial-up, and anytime you went on the internet, it was like, you remember that whole sound bite that you had to go through to get on the internet? Well, now look at how far we've come with innovation. And so if you want to invest your money into the future of innovation, then you can look at innovation ETFs. So some of the most popular innovation ETFs are managed through the ARK fund, which is managed by somebody named Cathie Wood. And Cathie Wood is now a famous investor because of the returns that she's gotten her investors. And just a disclaimer, I do have my own money invested in a handful of different ARK funds. But the whole idea behind these ARK funds, their symbols are all ARK, A-R-K, and then something. Like ARK K is their flagship innovation fund. If you put in a G here, it's the Genome Fund. If you put in an F here, it's the FinTech Fund. They have a fund for space exploration. They have a fund for a lot of different things in the innovation space. You can just go onto the website and see the different funds that they are. But again, the whole idea here is you are trying to get some exposure into the innovation side of the world. Another thing that you want to understand about these is that these funds also come with their own fair share of risk, because you're investing in a lot of smaller companies and a lot of startup companies. And these funds are also more on the actively managed side, which means that you have people actively working to try to find the best companies to invest in. And so your expense ratio, remember we talked about that a little bit earlier in this video, is going to be a little bit higher here, because now you're actively paying somebody to help manage this fund. But if you're one of those people that wants to be invested into the innovation side of things, into the newer companies, into the newer technology, and you want to hope that one of these smaller companies takes off, well, then some of these ETFs might be right for you. The sixth place where you may want to consider investing your money in ETFs are REIT ETFs. I didn't write the word ETF. REIT ETFs. And what a REIT is a real estate investment trust. So for all of my real estate people that want to get exposure to real estate on the stock market, this can be a way for you to get exposure to that by investing your money in REITs. When you invest your money into a REIT, you're investing your money into a company that invests in real estate or that invests into mortgages. So you're not getting direct exposure to the real estate per se, but you're investing in the company that invests in real estate. So the whole idea is, if real estate goes up, or if real estate is really booming, well, now this company is going to be booming because it's investing in real estate and you're investing in that company. So it's not a direct investment in real estate, it's an investment in the company that invests in real estate. A couple examples of REIT ETFs would be VNQ and IYR. Now, the thing that makes REITs interesting is REITs are required by law to follow something called the 90% rule, which says that REITs are required to pay out 90% of their taxable income or their profits to their shareholders, people like you, through dividends. And so a REIT's income comes through rental income. because these REITs own these rental properties, these investment properties, and they make money from rent. And then after they pay all their expenses, their management fees, their property insurance, their utility bills, their property taxes, their other fees, once they pay all their fees, then they take the rest of this income and 90% has to be paid out to people like you, shareholders, through dividends. An ETF's job again is to minimize the risk for you. So now instead of you trying to find the best REIT to invest in, now you can invest in a REIT ETF. That way we get exposure to a whole bunch of different REITs that we don't have to worry about trying to find the perfect REIT to invest in, because REITs do have a lot of volatility, especially the ones with the higher dividend yields. And this brings me to the 7th type of ETF that you might want to consider investing in, which are your growth stock ETFs. These are your companies that are trying to grow as big as possible, as fast as possible. And then within these growth stocks, you have your large growth stocks and your smaller growth stocks. Your larger growth stocks are a little bit more mature. These are your companies that might be making profits, that might be paying out small dividends, but they're still really investing in their growth. They're still investing a lot in innovation because they still want to grow bigger. So the first example of this would be investing in something like QQQ. So QQQ gives you exposure to the NASDAQ, which is essentially the 100 largest companies which are not financial. So these would be companies like Amazon and Apple and Microsoft and Tesla. A lot of these companies are tech companies, but when you're investing in QQQ, you're getting exposure to 100 of the largest non-financial companies, which many of them are in the tech space. On the other hand, you also have the small cap growth stocks where you can get exposure through something like SYLG. So SYLG invests into the smaller cap growth companies, and these are going to be a lot of companies that you might not have heard of. A couple popular ones are things like Crocs and maybe MicroStrategies, but the goal with both of these ETFs are to give you exposure to these growth type of companies. One gives you exposure to the larger cap ones. These are going to be more of the companies that you've already heard of. This one gives you exposure to the smaller cap companies, the smaller companies that are really fighting to become much bigger. Remember, more risk comes with more potential return, but you also have more chances to lose your money. This again goes back to your goal. What do you want? More risk comes with more potential return, but it also comes with more risk. Less risk compared to this comes with less potential return, but also less risk. Now, the key for any of these investing strategies to work that are discussed is you have to stay consistent and you want to keep investing your money, whether it's every week or every month. You want to keep investing your money into these ETFs. That way you can continue to build your portfolio of these ETFs. That way you can keep fueling the fire. And then you want to make sure that your fire has time to grow. The best way to build wealth in the stock market is to leave your money in the stock market for the long term, because the people that make the most money in the stock market are the people that invest for the long term. And remember, if you do want to learn more about investing your money in the stock market and some of the different stock market strategies out there, we got a free guide to investing your money in the stock market in the description below. Before we get into the next clip, I do want to let you know that if you are interested in learning more about how to invest your money into the stock market, our team has a free guide on investing your money in the stock market. This free guide will go over different stock market strategies, how to invest your money in the stock market, and how to build long-term wealth in the stock market by investing your money. So if you want to learn more about this guide and you want to start learning about how you can analyze companies and how you can research companies and how you can find good companies to invest in for the long term, that way you can build wealth in the stock market, you can read this guide for free when you sign up for our daily newsletter. If you want to read this free guide and start learning about how to invest your money in the stock market, I'll put the link to how you can download this guide in the description below. Investing your money right now can be scary and confusing at the same time. I mean, just look at some of these headlines. Think Advisor says the stock market is in a bubble and we could see a crash coming very soon. CNBC says the stock market cannot be stopped and it's going to keep going up. Then if we're talking about inflation, CNBC says that we have higher inflation coming, so get ready for more expensive stuff. But then if you turn to Fox News, they say that get ready for deflation, that we're actually going to be seeing deflation soon. Then if we turn to the real estate market, Forbes says that the real estate market is not in a bubble and real estate prices are going to keep soaring. But then at the same time, CNN says that housing demand is about to slow down and the housing prices are gonna come down. It's kind of like what Albert Einstein was hinting at. For every financial opinion, there's an equal and opposite financial opinion. Couple all of this confusing news with all the crazy stuff that's going on with our economy, with the unemployment rate and the inflation and the money printing, and now you have a lot of investors worried about what's going on and what they should be doing with their money. So in this video, I want to talk about what's going on and really give a warning to investors that we don't fall into investment traps or get scared by what's going on in the world, that we can really decipher what's important and what's not. Let's start with this. Yes, there are risks to our economy right now. There are risks because we are still seeing issues with unemployment. We're still seeing risks in the housing market because housing is still unaffordable to many different people. We're still seeing risks in the employment and labor market because companies are still struggling to find work. We're still seeing risks in the supply chain market because we still have supply chain bottlenecks and companies are still struggling getting parts. Not to mention the fact that we also have risks with inflation and or potential deflation in the future because of all the money printing that's been happening, and so there's a worry about how strong our dollar is going to be in the future. All these factors pose a risk to our economy, which ultimately can affect the value of our investments, because if the economy is going down, people don't have money to put in the stock market. If people don't have money to put in the stock market and people are scared about what's going on in the economy, they're going to pull their money out of the stock market, which could cause stock prices to go down. Same with real estate. If our economy is hurting, people don't have money to go out and buy homes. People don't have money to pay the rent, which hurt real estate prices, which could cause real estate prices to go down. This is where first you have to remember that nobody, I don't care who you are, nobody can predict what's coming next. Not even Warren Buffett and not even a random guy on YouTube. Nobody knows when the next stock market crash is going to happen, let alone how big the next stock market crash is going to be. Same with the real estate market. Nobody knows when the next real estate crash is going to happen, let alone how big it's going to be. What we do know is yes, we will see another stock market crash and we will see another real estate crash. We've been seeing these things happen for a century now and they will continue to happen. This is a boom and bust cycle that is a part of our economy. Every asset class has it and we've seen it happen and we will continue to see it happen. Now what you want to do as a financially educated investor is understand this and now make investment decisions based off of financials, not just emotions. Because a lot of people hear this and they get really emotional. They either sell their stocks or they sell their investments or they go out and buy based off of information that they might have heard, and so they get really emotional and they get panicky or they get excited and then buy or sell. And then this triggers people to sell before they want to or sell before they should, or they buy things that they shouldn't buy because they're hoping to make a quick buck. They're looking at the short term. They're looking at the next 3 months, the next 6 months, the next 12 months, and they're trying to see how can I make a quick buck. And if things don't align, if all the stars don't align perfectly and someone's headlines disagrees with yours, then you get scared and you sell or you buy. Here's the thing. Nobody can perfectly predict the future. Nobody thought back in 2018 that in 2020 we were going to see this massive pandemic which is going to shut down the economy, which is going to cause the stock market to crash and is going to cause the real estate market to ultimately explode. And then briefly after we see the stock market crash, we're going to see the stock market break brand new record highs. We can't predict these things, but what we can do is make educated decisions based off of what we do know, and then based off of that, make an investment strategy that aligns with our goals, and then put these two things together. You take your investment strategies and now you align that with everything that you know that's going on around you, and now you make investment decisions based off of that. That way now you're not getting clouded by all the emotion in the world, because right now there is a lot of emotion, especially in the investing and the financial world, and you do not want your money to be driven by emotion. You want your money to be driven by financials, because when your money is driven by emotion, your money is going straight down the toilet. The first thing you gotta decide is if you wanna be an investor or a trader, because an investor's job is to have your money invested for the long term. And when I say long term, I mean at the very minimum 1 year, but now we're talking about 10 years or 20 years or 30 years. So if you're an investor and you're thinking about investing your money for the long term, and now people are talking about a potential stock market crash happening, let's just say for the sake of this example and hypothetical, there could be a potential stock market crash in 1 year. If there's a potential stock market crash in 1 year, but you're looking to invest your money for the next 30 years, well, now a stock market crash in 1 year should not affect your long-term horizon, because you're investing your money for the long term, now for the next 12 months. This is where people say, but Jasprit, if you think the stock market is going to crash in 12 months, why should I invest my money now? I should just wait for the stock market to crash, then put all my money in there. Now I can buy all my stocks at a discounted price. Yeah, you're absolutely right. If you think the stock market is going to crash in 3 months or 12 months, it's better for you to now not invest your money, and then as soon as the stock market crashes, put your money in there, and now you bought all your stocks at a discount. The only problem with that is you could be wrong. If you're right, then yeah, you might be able to buy these assets at a 25% off discount. But if you're wrong and things go up a lot, well, now maybe you have to pay 25% more to buy these assets because you were trying to time the market. An investor's job is not to time the market. What an investor is trying to do is they're trying to find an asset that they believe is a good value or is undervalued, and now they want to buy this asset and accumulate as much of this asset as possible and then hold it for the long term because they believe in the value of this asset. They're not trying to sit here and trying to find the best price today and try to flip it in 2 weeks, that way they can make a quick profit. That's not what an investor does. That's more of gambling or trading, and so that's not what we're trying to do as an investor. What you're trying to do as an investor is you want to find a good investment that you believe in. If we're talking about the stock market, we're trying to find a company that you believe in, that you believe has good values for the long term. Now you want to buy this and hold it. Now, if the market does crash, something goes wrong, well, now what you can do is you can come in and buy even more. If you're the person that's just sitting around waiting for a crash to happen, well, now your money is just going to be sitting there idle, collecting dust while you wait for hopefully this crash to happen, which we don't know when it will happen. And we also don't know how big it will be. This is where, again, it goes back to your strategy. What is your goal as an investor? And you can have more than one strategy. Like I have multiple different investment strategies. I have some money that's going every single week into the stock market. I have an automatic deposit where every single week some money is withdrawn from my bank account and it goes automatically into my stock market portfolio. So now these ETFs are constantly growing every single week because I have some money always being invested in there. I also have my money in a different stock market brokerage where I'm looking for deals. When I find a good company that I believe is undervalued, that I want to own, that I believe in for the long term, then I will use this money to buy that. I also have money in real estate. With real estate, I'm looking only for cash flow. What I'm looking for now is how much money do I have to invest today, and then how much money am I going to make every single month from here on out. When it comes to my real estate investment portfolio, I really don't care what happens to real estate prices because I'm not buying my real estate investments based off of home prices. I'm buying my real estate investments based off of cash flow. I want to know how much money do I have to invest today and how much money am I going to make every single month. There's a difference between that and buying a property and hoping that you can sell it for twice as much in 5 years. That's not what I'm trying to do. I just want the cash flow with real estate. So there's different strategies, and what you have to figure out is what is your strategy? What are you looking for? And based off of the strategy that you have, now you got to put your money in the market based off of what's going on around you. With my money going into the market every single week, that hasn't changed because that is a long-term, purely passive strategy where now I consistently have some money going into the market. That has not changed, and that's not going to change. If the market crashes, hey, I'm going to put more money into the market, but every single week I got more money going into the market. When it comes to looking for individual market deals that I'm looking for in the stock market, all I'm doing here now is I'm being a little bit more picky. I'm not just going in and buying anything. I'm looking for deals. I am valuing companies. I'm trying to find companies that I believe in, that I think will be a good investment opportunity for me, and I'm being a little bit more picky right now because I don't just want to overpay for anything. It's the same thing in the real estate market right now. Yeah, there's not as much inventory out there, and yeah, you still see bidding wars on properties, but I'm still being picky. I want to make sure that any property that I buy is going to meet my investment goals. I want to make sure that I'm getting a minimum 7% cash on cash return, meaning for every $1,000 I invest, I better be making $70 a year in cash flow from my investment property. If it doesn't meet that, I don't want to buy it. And so I'm being picky with my real estate investment properties. And yeah, it's a little bit harder right now than before, but this is just the market that we're in. And so I have my investment goals set up, and based off of my investment goals, that's how I'm making my investment decisions. I'm paying close attention to everything that's going on around me, and now I'm taking that information and then I mix it with my investment goals, and that's where I try to figure out what do I want to do. The thing that makes it so difficult is sometimes we lack patience. I mean, I do the same thing. I'm not a super patient person. When I want something, I want it now, and I'll do everything I can to make it happen. But when it comes to your actual investments, you have to be patient, because if you're not patient, then that impatience can really end up biting you in the you know what. Maybe you got $5,000 or $500,000 sitting in an account somewhere, and you want to know what to do with this money, and you don't want this money just sitting around, and you want to invest this money. And so now you're trying to decide, okay, should I throw it in here or throw it in here? But now again, you got to be a little bit patient, and you just got to make sure that your investment aligns with your goals and it aligns with what's going on around you. The fear that so many investors, especially new investors, have right now is what happens if I put my money in the market and then the market crashes, or the real estate market crashes, and then the value of my investment gets cut in half. Well, all you want to do at that point is now come in and buy more. Your job as an investor is not to time the market, like Warren Buffett says. It's not about timing the market, it's about time in the market that matters, because now what you want to do is you want to find the right investments, whether it's stocks or real estate or whatever it is. You want to find the right investments, make sure it fits with your strategy, and then hold on to these investments for the long term. That way your investments can grow and compound and work to build you wealth. Headlines can be scary. and they can make you emotional. And that's exactly what they're supposed to do, because if they weren't, then these media companies would not be making any money. And so you have to understand that. There's a reason why some headlines are so scary. But now what you got to do is you want to read through the headlines, decipher what's going on, and now make sure that these things are aligning with your strategy. Now, before I get into what might be coming next in the economy, if you are interested in learning more about different ways that you can invest your money, especially in the stock market, our team has put together an amazing guide on investing your money in the stock market that will walk you through different stock market investing strategies, that will walk you through how to actually invest your money in the stock market and how you can start investing your money profitably in the stock market. This guide is completely free when you sign up for our daily newsletter, so if you want to read our stock market guide, I'll get the link to how you can download it in the description below. Now, when it comes to your actual investments, let's talk about the stock market first. The stock market and the economy are similar but different. The economy is actually what's going on around us. The economy is how many people are going to work. It's how much money are companies making. The economy is are companies growing and hiring more employees. The stock market is where people go to invest their money based off of what they think is going to happen in the economy in the future. Sometimes a stock price is going to be way up here while the company itself is not doing so good. And other times a stock price is going to be way down here while the company is doing pretty good. So a stock's price and a company's success don't always go directly hand in hand. It's not always linear, but they do end up kind of coming back together over the long term. Right now, we do have concerns in the economy. Like I talked about in the beginning of this video, we have concerns about inflation or potential deflation. We have concerns in the housing market. We have concerns about the job market because we still have millions of people that are not going to work. And we have lots of companies that are struggling to find work. We have issues with the supply chain in this country. And so there's a lot of things that are concerning in the economy. But now the question is, how much is that going to affect your investments? Now, typically the answer would be pretty obvious. Well, if the economy's got all these red flags, the stock market should have all these red flags. But at the same time, we have a lot of government factors that are influencing the stock market. Like we have a lot of money flowing into the market through the help of the Federal Reserve Bank to help prop up the market. We also have extremely low interest rates because the Federal Reserve Bank doesn't want to raise interest rates. These low interest rates make borrowing money cheap. That's good for you if you want to buy a home, and it's also good for big institutions who want to borrow hundreds of millions of dollars and then throw this money into the market. In the real estate market, it makes me want to pull my hair out when people say, oh, we're going to see a real estate price crash at the end of 2021. But you got to remember, real estate doesn't work like the stock market. You can't just see a sudden real estate crash because real estate prices move way slower than stock market prices do. In a regular market, not right now, but in a regular market, it could take anywhere between a month and a year for one real estate transaction to happen. Right now, obviously, we're seeing a lot of real estate transactions happen in less than a year, but in general, it can take months for one real estate transaction to happen. So for you to see real estate prices generally to come crashing down, that can't just happen in a matter of weeks or a month, because it takes a lot of time for that to happen. First, somebody has to list their home on the market, and then they're not going to get the offers that they want. And then maybe a few weeks later, the listing agent's going to say, hey, how about we lower the price a little bit and see if that brings in any more offers? If that doesn't bring in any more offers, then another month later, you might reduce the price again and then see what's going on in the market. And so real estate prices don't just suddenly come crashing down. What you need is you got to look at the buyers and sellers. If you have less buyers than sellers, then that's going to push real estate prices down. If you have more buyers than sellers, which is what we saw happen in 2020 and 2021, well, now all these buyers are fighting each other to buy the limited amount of homes out there, which pushes home prices up. That's why if you want to understand the housing market, you have to pay attention to a couple things. First, you have to look at home prices, because if people can't afford homes, then people are not going to be buying homes because now people just can't afford homes. We're starting to see that happen right now, where home prices are hitting a point where it's becoming harder and harder for people to actually afford homes, which is turning some people away from the housing market. The next thing you want to pay attention to is interest rates, because interest rates also influence how likely someone's going to be to buy a home, because if interest rates are high, then borrowing money is expensive and people are going to be less likely to buy a home. But if borrowing money is cheap, well, now people are going to be more likely to buy a home because mortgage rates are cheaper. And if home prices go up while mortgage rates go down, well, then that can keep people coming into the market, because yeah, home prices are higher, but your monthly mortgage payment isn't as high because your interest rates aren't as high as they were a little while ago. So if interest rates keep going down, then you'll see people buying higher home prices and justifying that because they'll say that they're getting a lower mortgage payment. So you have to pay attention to multiple different factors, and you also have to pay attention to what's influencing people to sell their home and what's influencing people to buy their home. Because if there's a lot of people selling their home and not that many people buying their home, well, now home prices are for sure going to come down, because now sellers are going to be fighting each other to get a buyer to buy their home. But right now, what we're seeing is the opposite. Is right now the buyers are fighting each other to buy one of the limited homes available for sale. So you want to pay attention to how many people are selling their homes. Are more people selling their homes than there are buying their homes? Well, then that could mean that you'll see home prices start to come down in the future. But if you don't see that, then you're probably going to continue seeing home prices go up until people can no longer afford homes. This is why financial education is so important. That way you don't just look at one headline and then you get emotional and then you buy or you sell based off of what the headline says, because you really got to understand what's going on, because there's a lot more to understanding the market and assets and the economy than just one sentence. And my goal for you is for you to be a financially educated investor, not just an emotional investor. Warren Buffett is the king of investing. I mean, that's why he's one of the richest people in the world. And Warren Buffett and his partner Charlie Munger just held the Berkshire Hathaway annual conference, and they talked a lot about how you should be investing your money, and they talked especially a lot about trading on Robinhood. I have the video here. I'm going to watch it, I'm going to talk about it, and then I'm going to get into some of his investing strategies that he thinks you should be doing. So let's get into that.
The trading apps, what do you think about Robinhood and other trading apps or fintech companies enabling all ages and experience to participate in the stock market?
Well, I'm looking forward to reading the S1 on Robin. That's a big thing you file with the SEC when you're going to be offering securities, and it's become a very significant part of the casino aspect of the casino group that has joined into the stock market in the last year and a half. And I do want to see how they handle the source of income when they say they don't charge the customer or anything. I mean, it'll just be interesting to watch how they describe it. I mean, but they have attracted, maybe set out to attract, but they have attracted, I think I read where 12 or 13% of their casino participants were dealing in puts and calls. I looked up on Apple, the number of 7-day calls and 14-day calls outstanding, and I'm sure a lot of that is coming through Robinhood. That's a bunch of people writing. They're gambling on the price of Apple over the next 7 days or 14. There's nothing.
So what he's saying is that Robinhood is encouraging this type of gambling, this type of casino type trading, because people are doing puts and calls. Those are options. And essentially, he's saying that people are gambling on the short-term price of stocks. He's given the example of Apple. And he's saying that a big chunk of these traders are coming from apps like Robinhood. So Robinhood, if you go and trade on Robinhood, you don't have to pay any money to trade. That's what he was talking about, the commission-free trading. And the reason why that's so interesting is because a lot of your traditional brokerages, back before Robinhood came out with commission-free trading, and then Charles Schwab started announcing commission-free trading, and then every other brokerage announced commission-free trading. Before then, every brokerage would charge you money to make a trade. And so when a company charges you money to do something, in this case make a trade, it's very clear how they make money. They charge you money to make a trade. But in Robinhood's case, they came out and they did not charge you as the customer anything to make a trade. And so the way that they make money is they make money through actually working with a clearinghouse. They make money when you make a trade, but they don't charge you. They work with this separate kind of agency that allows them to do that. And that's what he's talking about, that when Robinhood releases their S1, which is a statement that you have to give to the Securities and Exchange Commission, the SEC, they will have to disclose how they make money. And so that's what he's interested to see, is how they make money. And because Robinhood makes more money when people make more trades, he thinks that Robinhood is going to try to encourage more trading, risky trading, gambling, as he likes to call it, because if more people are making these type of trades on Robinhood, then Robinhood's making more money. And the user, the consumer, you in this case, you don't realize what it's costing you because you think you're paying nothing. And Robinhood keeps encouraging this by encouraging people to trade and gamble. You know, when you make a trade on Robinhood, you get hit with confetti and you get hit with balloons, right? You get that feeling where you feel like you're playing a game. And the reason that's good for Robinhood is the more kind of this game that you play, the more money Robinhood makes, even though you as the user don't see how Robinhood makes money. So that's what he kind of has an issue with, because he says that it's encouraging this gambling, this casino type structure of the stock market, even though the stock market is real money. I mean, I guess so is gambling. It's real money too. But the stock market is a little bit different than a casino, because in the stock market, you're supposed to be buying shares of actual companies, not just gambling your money, hoping to make money by pulling the lottery. But let's see what he has to say next.
Illegal about it. There's nothing immoral. But I don't think he'd build a society around people doing it. I mean, if a group of us landed on a desert island, we knew we'd never be rescued, and I was one of the group, and I said, well, I'll set up the exchange over here, and I'll trade our corn futures and everything around it. I think the degree to which a very rich society can reward people who now know how to take advantage, essentially, of the gambling instincts of the not only American public, worldwide public. It's not the most admirable part of the accomplishment, but I think what America's accomplished is pretty admirable overall.
So what he's saying is kind of going back to the gambling aspect. Warren Buffett's saying that, yeah, it's not illegal to make money. It's not immoral to make money. But he says that, kind of he gave the idea of going on an island and now you're trading the future derivatives of, I forgot, corn or whatever he said. It's people just gambling about the short-term price swings, and people are learning how to do it, and they're making a lot of money doing it, and it's causing the stock market to go very weird. And so that's what he's talking about. He says that, yeah, it's not immoral, it's not wrong, but it's obviously concerning him because he's a long-term investor, right? It doesn't benefit Warren Buffett that, you have these wild short-term swings in the stock market. But he also says that in the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. He's said that for decades now. And what that means is in the short term, you can see popular stocks see wild swings because it's very popular, right? When people get behind something, they get excited about something, they start buying it up, and that can make a popular stock go up, even if fundamentally the stock is not worth a certain amount of money. But over the long term, he calls it a weighing machine because over the long term, that kind of gets balanced out. You get to see equilibrium in the market where over the long term, you see strong companies continue to go up and you see weak companies eventually come back down to earth. So, that's what his philosophy has been forever. And I'm sure what he's trying to say is that, over the last, what he called a year and a half, ever since the pandemic started, you've seen this huge influx of retail traders into the market, which is great. And a lot of these people are coming in for the first time and they're trading using things like Robinhood, which gamifies the whole stock trading process. And then they give you cheap and easy margin, cheap and easy debt that you can leverage up your trades. And since the pandemic started, after the stock market crash, the stock market has only gone like this. It's gone pretty much straight up. And so a lot of people that have been trading or became new traders after the pandemic have only seen an upwards market, and a lot of people have been leveraging up their bets, and people have been able to make a lot of money very quickly, which is great. But the concern a lot of people have is when things turn around, when things slow down, if you have a whole kind of industry of people that are trading money without necessarily knowing what they're doing, without necessarily knowing the risks, without necessarily knowing how expensive things can be if you are leveraged up to your eyeballs and things turn around, then that can cause a huge kind of shakeup, not just in the retail trading market, but in the entire industry. So it sounds like that's something he's worried about, but let's get back into it.
And I think actually, American corporations have turned out to be a wonderful place for people to put their money and save, but they also make terrific gambling chips. And if you cater to those gambling chips when people have money in their pocket for the first time, and you tell them they can make 30 or 40 or 50 trades a day, and you're not charging them any commission, but you're selling their order flow or whatever, I hope we don't have more of it, I'll put it that way. And I will be interested in reading the prospectus. Charlie?
So before we get into Charlie Munger, kind of just like what he talked about, He's saying that Robinhood doesn't make money by charging you commission on your trades. They sell your order flow. That's what he's talking about, where they work with a third party. And so anytime you make a trade, they make money through your kind of order flow, but they don't actually charge you, which is why Robinhood wants to encourage a lot of trading, even though people might not necessarily know the risks of trading. So let's see what Charlie Munger has to say.
Well, that is really waving the red flag at the bull. I think it's just god-awful that something like that would draw investment from civilized men and decent citizens. It's deeply wrong. We don't want to make our money selling things that are bad for people.
So that's interesting. Obviously, Charlie Munger has some strong words. Charlie Munger has been Warren Buffett's business partner, right-hand man for a long time. He's a very successful investor. He is a billionaire. So, he has credibility. What I thought was interesting, he says that you don't want to make money selling things that are bad for people, as they have Coke and Diet Coke right next to them. But separate topic, but very interesting. Obviously, they've been around a long time. Maybe they're not hip to technology the way that the younger generation is, but they've definitely been around the investing space. Definitely something to listen to. I wonder to see what Warren Buffett has to say about that.
We've got the states doing it with the lottery,
No, but that's bad too.
Yeah, I understand.
That's very
but
bad.
Once you
very bad.
institutionalize-
That's
yeah.
one of the things that's wrong with it. It's getting respectable to do these things. The states are just.
They call the lottery an idiot tax because the people who blow all their money on lottery tickets are, well,
As bad as Robinhood.
Well, in a sense, they're worse. I mean, they're really taxing.
I know
people based on
I know.
Yeah, they're taxing hope.
Not only that,
And they don't get much in the way of taxes from here, Charlie, when they do that.
The states in America replaced the mafia as the proprietor of the numbers game. That's what happened.
Yep.
They pushed the mafia aside and said, that's our business, not yours. Doesn't make me proud of my government.
When I was a kid, my dad was in Congress. They had a numbers runner in the House office building, actually.
So that's the end of that video. So as you can see, they have some very strong words about people trading their money in the markets, people trading their money using things like Robinhood. They have very strong opinions on people, as they call it, gambling their money with high margin, doing options trading, even though people have been able to make a killing. I mean, some people have made 100 to 1,000% returns since the pandemic started. So people have made a ton of money, and a lot of long-term investors are really just trying to see your 7 to maybe 10, 12% a year returns. And so the fact that people have been able to do it in such a short amount of time is pretty impressive. I think, but there's a lot of concerns over the long-term health of the stock market and traders if things slow down, because nothing can go straight up forever. Now, obviously things are accelerated with all the free money that's been printed, with all the stimulus that's been going on, with everything else, kind of with the government aiding businesses and people. And so obviously that all this free money goes into the economy, goes into people, and it has to be absorbed by the system, because we've had trillions of dollars printed between 2020 and 2021. And so this money has to be absorbed. One of the places that's going to go is the stock market. And now on top of that, we have a lot of young people, a lot of young traders, a lot of first-time traders entering the stock market. So they're putting their money into the stock market, all this new money. And on top of that, a lot of people are trading with margin. So not only do you have all this new money coming into the market, but now this new money is creating new debt, because Robinhood has very easy access to margin. And it's not just Robinhood. It's a lot of these kind of newer trading apps. A lot of them have very easy access to margin, which can be good if you do it the right way. But if you don't know what you're doing, it can be very, very, very painful financially. And so you have a lot of money coming into the market. You have a lot of margin coming into the market. So obviously that's going to help prop things up. So how should you be investing your money according to Warren Buffett? So I have an article where he goes over how to do that. And by the way, if you are interested in learning how to invest your money in stocks, our team put together an amazing PDF that walks you through stock market investing. You'll get to learn some different stock market strategies. This PDF is completely free. If you want to read that PDF, you can get it by clicking the link in the description below. So going into this article where Warren Buffett goes over some different investment tips for 2021, he says that there are 3 tips that you need to remember when you are investing your money in the stock market. Now, the first thing I want to kind of remind you, When we talk about investing, investing means that you are investing your money into an asset, in this case the stock market, because you believe in the underlying value or fundamentals of this asset. So when you're investing in a company, you're investing in this company because you believe in the long-term health, strength, and wealth of this company. And so when Warren Buffett talks about investing, that means investing your money for at least a very bare minimum of 1 year. Typically, we're talking about a long time. And in Warren Buffett's case, he means forever. Because when he talks about buying a stock, he wants to buy it and own it forever because he believes in this company for a very long time. And so that's something you got to keep in mind. It's very different than trading, where when you trade a stock, you buy it and you want to sell it in 2 weeks or 2 months because you just want to make a quick profit. But here are 3 fundamentals that he says that you want to remember when you are investing. First thing he says, that patience is paramount. So this goes back to kind of how long are you going to keep your money in the stock market? Because it takes time for things to really grow in the stock market, right? The stock market and the economy are similar but different. In the economy, this is what's actually going on. The stock market, this is where people bet on what's actually going on. And so people come to the stock market, and if they think the economy is going to go up, they will put their money in the stock market. If they think the economy is going to go down, they will preemptively sell and pull their money out of the stock market. And so the stock market and the economy are similar, but they are different at the same time. And so when he says patience is important, paramount in this case, it means that you got to give time for your investment to grow, because people are going to be emotional, especially traders, right? They're going to come in. If they think things are going to go up, they'll buy. If they think things are going to go down, they will sell. But if you want to make money as an investor, you have to be patient and you have to be willing to ride out these swings. The second thing he talks about is invest in quality. One of his famous quotes is, price is what you pay, value is what you get. And so what he means by that is, when you're investing in companies, don't just invest in hype. Just because everybody else is buying it does not mean it is a good investment. Look for something that is going to have long-term value. What is going to have quality and value that people are going to want for years, if not decades into the future. You might have to pay a little bit of a premium for this quality value, but over time, if you have the patience, that could mean very profitable. That has worked out very well for him. And the third thing he says, kind of reiterating, is stay committed for the long term, because successful investing is not something that happens overnight. Investing is a long-term game, and according to him, one of his famous quotes again is, be fearful when others are greedy, be greedy when others are fearful. What that means is, when people are greedy, when everything and everyone keeps making so much money, that's when you want to start to get fearful. Because when people get greedy and they start to only see dollar signs and they start to think that everything can only go up, that's when you want to start to take a step back and understand what's going on and make sure you're making smart investment decisions. That doesn't mean you shouldn't have any money in the market. That doesn't mean that you shouldn't be investing or trading at all. That means you got to start to just be a little bit extra cautious. And when people are fearful, that's when the market goes down. That's when people get worried about the economy ending. That's when people get worried about the entire economic system failing. When people get fearful, they start to sell. And that's the perfect opportunity where you want to come in and be greedy, and in this case, come in and buy, because that's when you can buy assets, stocks, at a discounted price. So be fearful when others are greedy, be greedy when others are fearful. And the reason why that's important for the long term is because if you're investing for the long term, then you're going to see these type of swings. And when things go down, that's when you want to come in and buy more, especially if you have a value investment. Because if you believe in the value of something and the price of it goes down, well, now you can come in and buy this great value thing at a huge discounted price, right? So the 3 keys that he talks about, that if you want to be a successful investor, are patience, quality, and stay committed to the long term. I'm sure you know that the stock market is a wealth building tool, but many people are scared to invest their money in the market because they don't want to lose money. I mean, there's story after story of people losing money in the stock market, and there's probably more articles on the internet of people talking about how to manage your losses and manage your risks instead of actually making money. If you're a rational-minded person and you hear of all these people making money in the stock market, you might be confused. Why are so many people losing money in the stock market if the stock market goes up? I mean, take a look at this historical chart of the stock market, which shows the stock market over the last 30 years. We've seen dips, we've seen crashes, but we've also seen the stock market way higher now than it was 30 years ago. Well, it's not so simple. And if you've ever invested your money in the stock market, you understand that successfully investing in stocks isn't as simple as those people on Facebook ads with the fancy cars keep saying it is. Today, I want to go over some of the big reasons why people lose money in the stock market and some of the common mistakes that you should avoid. But before we get into that, I need you to do me a big favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The first and most common reason why people lose money in the stock market is because they are trading, not investing. There is a way to make money as an investor and as a trader, but a lot of people come into the stock market thinking they're investing when they're actually just trading. A stock market investor is a person who buys stocks and plans to hold on to their investment for at least a year. A stock market trader is somebody who buys stocks with the goal of selling them quicker than a year. The longer you own an investment, the better chance you have to make money on it. In 1973, a Princeton University professor took 100 monkeys and he blindfolded them and he gave them darts to throw at a financial newspaper, because when they threw darts, they would land on a random stock, and then he wanted to see how these stocks would perform over the long run, because his theory was that you don't need to be a rocket scientist to be a successful investor, because these random monkeys who are throwing darts blindfolded at these financial newspapers and financial stocks, he thought that over the long run, these monkeys would be able to beat the average person, and he actually thought that they would be able to do just as good as the experts. Well, this Princeton professor was wrong. Not only did the monkeys beat the ordinary people, but they also beat the experts. The reason the monkeys did so good in the stock market is because, well, they didn't know what they were doing, so they didn't feel pressured to sell. All they did was throw darts at a newspaper. They didn't have to listen to the news talking about how the economy is going to crash, and they didn't have to sit there and watch their portfolio hover up and down. Over the long run, our economy has always gone up. That doesn't mean it has to be a straight upward trajectory, but it does go up over the long run, and that helps stock prices go up too. Now, this doesn't mean that every stock is always going to go up. I mean, if your company is on the verge of bankruptcy or failure, then your stock is going to go down. But growth in the economy and the stock market takes time. If your goal is to make money in the stock market tomorrow or next week or next month or this year, then you don't have that much time for your stock to grow because you're trading. In the short term, the stock market is emotional, and anything can trigger the stock market, even a tweet from a celebrity, because it's emotional. This puts traders at a higher risk of losing money because you're trying to make money in a short time span. But if you just increase your investment time span, now you're giving your company more opportunity and more time to make more money and grow, which gives the stock more opportunity to grow as well, assuming that your company doesn't go bankrupt. And this brings me to number 2. Understand the media. I used to say ignore the media, but you probably want to know what's going on in the world, so it's better for you to understand what the media is actually trying to say. Let me give you a quick YouTube class on how to understand what the media is saying. When you hear the media say, "Good evening, viewers. Wow, the stock market is soaring and it looks like it cannot come down," what they really mean to say is, "Hello, the stock market is going up quite a bit, which means the original investors who invested early are getting rich, and now all these new investors who are investing because they have the fear of missing out, FOMO, are about to get burned and lose a lot of money." When the media says, "Good evening, friends. Today I have some somber news because the stock market is crashing and we don't know what's lying in our future," what they really mean is, "Good evening, you random viewers. The stock market is very cheap right now because people are panicking and they're selling their stocks. But if you believe in our economy and our stock market for the long term, this is a great opportunity for you to come in and buy." And when the media says, "Good day, my lovely viewers. Our next guest is here to tell you why they think you should be selling all of your stocks, that way you can buy coconuts," stay tuned. What they really mean is, "Hi, I don't know what time of day it is, but I found somebody who has a very polarizing opinion which will help our ratings, because you hopefully are gonna get triggered and tell your friends to watch my crazy shit." Look, the media is not in the education business. Chances are, if the media is already reporting on a stock rally, chances are you missed that rally. Remember, if you're an investor, you're investing for the long term. These short-term dips and rallies don't mean anything. Your goal is to see your company grow and make more money over the long term. So you don't need to pay attention to the day-to-day media hype. If your company is having serious fundamental issues, that's a different story, but every company is gonna have good and bad news. You need to be able to read through the lines, that way you can actually understand what's being said. Third, invest the right way. Investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. Who you calling random? And here's another one to add to the list. Never invest more than you are willing to lose. Margin trading is when you turn your $1 investment into $10 because you are trading with OPM, other people's money. You are borrowing money to invest in stocks. Investing in stocks is risky. You can lose your money, and if you just lose your own money, that's one thing, it's bad enough. But if you're losing somebody else's money because you're trading on margin, Now, it's an even bigger problem. You can get sucked into a downward spiral of debt because you're trading money without knowing what you're doing, using somebody else's money, and now not only do you lose your own money, you lose somebody else's money, and you have to pay that back plus interest. But you can avoid that mess by using your own money and not trading on margin. Now, if you do want to invest in stocks, you have to use a stock brokerage like our sponsor, Webull. Webull is a digital brokerage. They are super simple to use, and all you have to do is create a free account, fund it, and then you can buy or sell whatever stocks or ETFs you want right off of your phone or computer, and they don't charge you a penny to make a trade because they are a commission-free brokerage. And the best part of all is that for a limited time, Webull upped their promotion because now they are giving you 2 free stocks valued at up to $1,600 when you deposit $100 into your account when you use our link in the description below. To be fair, I don't know how long this 2 free stock promotion will last, so take advantage of it while you can. And Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. They're free to create an account, they don't charge you a penny to make a trade, and they are giving you a free stock just for using them. So if you want to learn more and start investing, I got the link to how you can do that in the description below. The fourth thing that I want to talk about is that everybody thinks stock market investing is about picking stocks, but that's not true. And if you ask me, most people should actually not be in the stock picking game because people either cannot manage their emotions, they cannot manage their investments, or they do not want to do the research required to invest in stocks. But just because you shouldn't be picking stocks doesn't mean that you shouldn't be investing in the stock market. There's more than one way that you can invest in stocks. Everybody knows that you can invest in individual companies like Tesla, Netflix, and McDonald's. This is what stock picking is. But you can also invest in ETFs, which are groups of stocks. When you invest in individual companies, so Netflix, Tesla, McDonald's, now this requires more research and more work because you want to be actually researching these companies and make sure that they're strong and making money as you invest with them. And so it comes with more risk too, because if the company you invest in fails or has problems, now your whole investment goes down. When you invest in an ETF, which is a group of stocks, now you can get exposure to the entire stock market as a whole or a certain sector of stocks. If let's say you invest in an ETF like SPY or VOO, again, I'm not telling you what to invest in, just giving you examples. These 2 funds invest in the top 500 companies on the stock market. So if you invest and buy shares of SPY or VOO, now you're essentially getting exposure to the top 500 companies in the stock market without having to actually go out and buy all these 500 companies. Now, if the stock market goes up, your fund generally goes up. And if the stock market goes down, your fund generally goes down. You have ETFs for almost everything. I mean, you have ETFs for the general stock market, like I just talked about. You have ETFs for tech stocks, healthcare stocks, real estate stocks, growth stocks, dividend stocks. If you don't want to be in the business of researching and analyzing your investments, then the ETF way is a much better way to go because you lower your risk and you don't have to do all that. And this brings me to number 5. Make sure your goals align with your investments. Just like how there's more than one way that you can invest in stocks, there's more than one way that you can make money in stocks. Lots of people say that they want to make money in the stock market. But how do you want to actually make that money? And how quickly do you want to make that money before you sell? If you invest in a company and you see it go up 30, 40, 50%, do you know when to sell? If your stock is paying you a dividend, should you reinvest that dividend or should you spend it on something nice? You need to understand what your goal is and make sure your investing aligns with your goals. If your goal is passive income, you should be investing in dividend paying stocks. And if you don't need that passive income right now, then you should be reinvesting that dividends, that way your dividends get bigger in the future. Do you want to see the returns that you want over the next 3 to 5 years, or do you want to see these returns last you until retirement? Companies like growth stocks come with higher risk, but you can get bigger returns in the short run, while companies like blue chips, your more stable companies, can give you those returns for the long run. Each one of your goals is going to come with a different strategy. If you're just buying stocks because you want to make money, then you're jumping into war without having a plan on how to fight. Start with the end in mind and then work backwards, that way you can create a plan. This is what financial education is all about. Thank you for watching. If you enjoyed this video, here's a video on building wealth that I think you'll love, and while you're at it, download our free stock market PDF, and as always, keep hustling. You have the physical aspect, the mental aspect, the spiritual aspect, and then finally, the financial aspect. If you want to live a happy life, you need to be fit in all 4 of these things.